Welcome back to the deep dive. Today, we're diving into, well, a pretty intense situation involving a project that's become a real case study. Limitless Labs and their LMTS token over on the base chain. And this one comes directly from you, our listeners. You asked us to really dig into the basics here. Who are the people behind Limitless Labs? What's their actual long-term game plan, based on their white paper, their strategy docs, and how active are they on social media? What's the vibe like? So that's our starting point, looking at the foundations they tried to build.
Exactly. But, you can't just look at the blueprint. We absolutely have to follow the data, and that means looking at how this, well, pretty solid-looking team and ambitious vision actually met the market. So this dive goes straight into analyzing the execution, the transparency, or maybe the lack of it that really led to some dramatic fireworks right after the token generation event, the TGE. It's about more than just their plans. It's about the hard lessons learned when a project with decent tech, frankly, botches its launch communication.
Okay, so let's set the stage properly. Because before the trust evaporated, there was a reason the market seemed pretty optimistic about this team. We need to understand why they were seen as capable. All right, let's get into it. Who are the main players here? The core team driving Limitless Labs. Sounds like there are four key leaders, starting with the CEO, CJ Hetherington. What's his story?
Right. Hetherington is definitely positioned as the main driver. He's Canadian, comes from a traditional venture capital world. He was venture partner at TA Ventures. He kicked off Limitless Labs back in November 2023. Now, that VC background is significant, right? It suggests he knows about scaling, funding rounds, long-term financial strategy, things that aren't always front and center in purely crypto-native projects. And there's more. He's also been involved in the Web3 public goods space, like with Gitcoin funding. So that signals he's not just, a VC looking for a quick flip. It suggests some buy-in to the broader decentralized idea, trying to build within that ecosystem.
And he certainly wasn't shy about the vision. I saw a quote where he called prediction markets the most consequential asset class of the century. That's a big statement. Does the team around him match that kind of ambition?
It seems like it. You've got Roman Mogli as COO, focusing on the operations, the day-to-day stuff. Dima Horshkov is the CPO, handling procurement and business contributions. And Rev Miller is involved in the tech and strategy side. So a dedicated core.
That's the inner circle, but you mentioned it felt more institutional. What about the broader team? Any big advisory names involved?
Yeah, the full team is pretty substantial, around 25 people, spread out globally. And their backgrounds are really relevant people from places like Gitcoin, Reface, which is that AI social app, and Witnit, the Oracle network. That mix suggests they've got chops in governance, scaling platforms, and the core tech needed. But the big name that jumps out is Arthur Hayes, founder of BitMEX, head of Maelstrom. He came on as a key advisor after their strategic funding round. Getting someone like Hayes involved, well, that sends a pretty strong signal to the market, doesn't it? It suggests sophisticated players saw genuine potential here, validating the tech vision.
Okay, so a founder with VC chops, a decent-sized global team, Arthur Hayes advising. Structurally, it looks strong. Now let's talk about commitment. The tokenomics, specifically the vesting schedule. How does that stack up? Does it show long-term thinking?
This is actually one of the standout features of their design, on paper at least. The team's commitment seems structurally baked in through a really, really stringent vesting schedule. It's designed to stop any quick dumps. Team tokens are locked for 36 months, that's 3 years.
3 years. And what's the key detail within that?
The hard lockup. There's a mandatory 12-month hard lock. That means absolutely 0 team tokens unlock at the TGE. Nothing. Plus, team members have to be working full-time on the project for 2 whole years before they even start receiving tokens. This is important. Lots of projects let some team tokens unlock early, for costs or whatever. Limitless explicitly didn't do that. Their own docs call it the most stringent arrangement in the LMTS tokenomics. The idea is to align the team completely with the long-term success of the platform. If it fails in year 1, they get zip. If it's rocky in year 2, they still wait. So structurally, on paper, it signals exactly the kind of long-term commitment investors want to see.
All right, so a team seemingly locked in for the long haul. What were they actually building towards? Let's shift to the vision, the roadmap, the strategy docs up to 2028.
Yeah, the documentation is pretty detailed, laying out the vision quite far ahead. Oh, and just to clarify something, there was an older white paper for a different token, LMTDC on Ethereum. But the current focus, the one we're talking about, is all LMTS on the base chain. They clearly pivoted towards base for efficiency and lower costs.
Got it. So focusing on the current plan, what were the concrete steps for, say, 2025? What were the milestones?
2025 was planned to be pretty aggressive, very tactical. Q1 through Q4 was all about building the foundation. So more protocol testing on base, bringing in new creators, which is key for content on the prediction market and hitting their funding targets. They were aiming for about $4 million raised by June 2025, and a big piece was market expansion, specifically into those fast-paced markets, hourly and daily predictions. That requires serious tech capability, right? Instant resolution, high throughput. They needed to build the infrastructure to handle that kind of speed.
Speed and scale, okay. And before the TGE drama, the platform itself was actually doing pretty well, wasn't it? What kind of traction did they have?
They really did. We're talking significant measurable use. The platform had already processed over $400 million in trading volume since it started, and they had over 37,000 active users. Now, put that in perspective. That volume made Limitless Labs the biggest prediction market platform on base at the time. And if you zoom out to the whole prediction market scene, they were already competing with the big players, like the regulated ones, Kalshi, and the major decentralized ones like Polymarket. So it wasn't just hype. The tech was working and people were clearly using it. It showed there was real demand for what they were building.
That $400 million figure is definitely eye-catching. It proves people wanted it. But why were they choosing Limitless? What was the tech edge, especially compared to, say, a standard AMM setup?
Okay. Yeah, that's a key engineering choice they made. They went with a central limit order book Socielo bib system instead of an automated market maker. That's critical. AMMs, as you know, can have big slippage issues, especially with larger trades or when things get volatile. A CLOB, though, aims for deeper liquidity, better order matching, and more accurate real-time pricing. For these super fast prediction markets where milliseconds matter, a CLOB offers a more professional trading feel. It reduces things like front-running risk and gives better execution quality. That's what serious traders look for.
And those fast markets, hourly, daily settlements, instant resolution, that must be a beast.
Well, absolutely. It demands really solid Oracle systems and super quick settlement processes. No lag allowed. Committing to those fast expirations makes a platform way more appealing for day traders wanting quick results and efficient use of capital. They also supported markets with multiple outcomes, not just yes-no, and had ways to split and merge tokens efficiently. It was designed to be a pretty sophisticated financial tool.
But the real hook, the thing tying the token's value to platform success, was this revenue-backed buyback mechanism. How does that work, and why is it so important for the LMTS token?
Right. This is supposed to be the economic engine driving long-term value. It's different from just burning tokens or basic staking rewards. Limitless Labs designed it so that platform revenue, mostly from trading fees, gets converted directly back into token value. How? Through systematic open market buybacks of LMTS tokens. So the platform is constantly using its operational earnings to buy its own token. This creates ongoing, measurable demand for LMTS, directly linking its utility to how much trading is actually happening. As that $400 million volume grows, theoretically the demand for LMTS should grow too. It attempts to make the token less speculative and more fundamentally backed by revenue.
Okay, so we've got this impressive picture building, a committed team, big name advisor, sophisticated tech like the CLOB, real traction, and this clever buyback mechanism. This brings us to communication. Our listener asked about their social media frequency. Were they making enough noise to support this launch?
Oh yeah, they were very active, and strategically so. The main hub was their official X account at Try Limitless. They were constantly pushing content there, especially leading up to the TGE, really trying to shape the narrative.
And part of that narrative shaping involves some interesting PR moves, right? Particularly around exchange talks. Tell us about that Binance thing.
Yeah, that was definitely a calculated move back in October 2025. The CEO, CJ Hetherington, went public with details about their negotiations with major exchanges. He specifically mentioned Binance requiring, reportedly, huge commitments like 2 million BNB and complex fees.
That sounds less like just sharing info and more like a strategy.
Exactly. And he contrasted that directly with Coinbase, framing their approach as being more about the project's actual value and compliance, not just massive listing fees.
Yeah.
So by revealing this, he was doing a couple things. Signaling transparency, maybe trying to look like the principled underdog fighting against expensive legacy systems right before the big launch.
Smart PR.
Yeah.
And besides that, were they actively building a community, any programs to get people involved?
Definitely. They invested quite a bit in community growth. There was the Profit Challenge, rewarding users for making accurate predictions. They did an airdrop called the Wall Chain Quackers Epoch 1 for early folks. And crucially, the Limitless Points program, Season 1, was designed to reward early users and liquidity providers, build that loyalty, that sticky capital, before the token even launched. You can see the buzz was working. We looked at the data around November 7th, 2025, over 4,600 tweets mentioning LMTS from nearly 550 unique people, and the sentiment, overwhelmingly positive. About 55% bullish, only around 9% bearish, the rest neutral. So, the social momentum was strong. People believed in the potential.
Right. So let's recap the setup. Team locked in long-term, check. Sophisticated tech with real usage, check. Revenue-backed tokenomics, check. Positive social buzz, check. Everything seemed perfectly aligned for a smooth, successful launch, which makes what happened next, the actual execution, so jarring. That failure to communicate about one specific operational detail, this banana gun thing,
Yeah.
it just torpedoed market trust.
It really did. Catastrophic communication breakdown. It just goes to show you can do 1,000 things right, but one major misstep in transparency can undo it all. And this is where the story really turns. We shift from the planning documents to the brutal reality of the market. The LMTS token saw just extraordinary, almost unbelievable volatility right around the TGE on October 22nd, 2025. This part of the story basically defines the project now.
Let's walk through that timeline just to grasp the speed of the collapse. Before the TGE, say October 20th, 21st, the token was stable-ish, around 50 to 76 cents. That seemed like the expected starting point.
Then, launch day, October 22nd. All that positive sentiment, the strong fundamentals we talked about, it initially worked. The token surged, hitting an all-time high around 72 cents. That shows there was real initial demand, a successful kickoff, you could say.
But that high lasted hours. The crash started almost immediately, didn't it? By October 25th, just 3 days later, it had plummeted to around $0.48. That's a 33% drop from the peak. Anyone who bought in on launch day felt that instantly.
And it was just the beginning. Panic clearly took hold. The price kept falling through the end of October. By Halloween, October 31st, it was down to $0.29. That's a 60% nosedive from the high. Think about that. If you were a regular investor buying the hype, you lost over half your money in less than 10 days. That kind of wipeout doesn't just hurt wallets, it destroys trust.
Where did the price eventually find a floor, at least temporarily?
By early November, it seemed to stabilize, but in a really depressed range, like $0.26 to $0.28. So yeah, we're talking a massive 61% to 63% drop from that peak just a couple of weeks earlier. So the big question is, if the team was locked up for 3 years, what on earth caused this?
And the data points pretty clearly to insider activity, right?
Yeah.
Actions that looked exactly like a team dump. Right after launch, huge token transfers and immediate sales started popping up on-chain, coming from wallets linked to the Limitless team. Can you recap those specific examples?
Yeah, the on-chain evidence was pretty stark. One wallet moved 5 million LMTS and sold them right away, netting about $2.3 million even at the falling price of $0.46. Then another batch, 10 million tokens, was moved and sold immediately. These massive sales just flooded the market with unexpected supply, triggering more price drops and, understandably, widespread panic.
So when the community saw this trackable selling that seemed to completely contradict the 36-month lockup promise, the founder, CJ Hetherington, came out with this explanation. The banana gun mechanism. What was that supposed to be?
Theoretically, it was pitched as an anti-sniping bot measure. The idea, according to the team, was to stop automated bots from gaming the launch, soaking up initial liquidity, and making quick, predatory profits at the expense of regular investors.
Yeah.
So the stated intention sounded protective.
Okay, protective intent maybe. But how was this banana gun actually supposed to work, and why did it involve the team apparently selling millions of dollars worth of tokens immediately?
Well, based on what we can piece together, the likely idea was that team-controlled wallets would deliberately flood the market, maybe to trigger stop losses on the bots, or perhaps to rapidly drain the initial liquidity pools those bots target, kind of create temporary chaos to shake out the automated traders. But here's the absolute core failure. It all hinged on trust, and they destroy that through secrecy and information asymmetry. It's a deadly mix. Let's pinpoint the 4 key ways this went wrong. Okay, first, no prior disclosure. They cooked up and used this market-altering mechanism and told no one about it before launch. It only surfaced after people spotted the suspicious trades. That's reactive, not proactive.
Exactly. Second, zero transparency. If it was genuinely meant to help, where were the rules, the documentation, an independent audit to verify its function and what happened to the funds? There was nothing. They basically asked the market to trust them blindly with millions based only on a post-crisis explanation. Third, how the market saw it. When there's no clear information, people assume the worst to protect themselves. Seeing huge sales from team-linked wallets, the market read it as a classic team dump. Plain and simple, the stated anti-bot purpose didn't matter because it wasn't verifiable.
And fourth, the timing of the explanation. It was purely reactive. They only explained after being caught out, offering this vague banana gun story. And like we noted, vague explanations alone can trigger a collapse of trust when markets are already shaky.
I have to push back a bit here. If the team was truly locked up for 36 months, wouldn't using those banana gun funds to buy back tokens after the initial chaos and doing it transparently have been a much stronger signal than selling immediately, which just looked like cashing out?
That's precisely the crux of the execution failure. Proper management would have involved, say, a smart contract outlining the rules, maybe appointing an independent party to handle the funds, and yes, using those funds for transparent buybacks or even burning them would have demonstrated commitment. Instead, the sales triggered stop losses, retail panic, liquidity vanished, and social media went into overdrive with FUD. It created this awful negative spiral. The price collapse was basically self-inflicted the moment trust broke. So that massive price drop immediately makes you question the underlying tech. Was the LMTS token contract itself the problem, or something in the tokenomics? Let's look at the contract itself. It's an ERC20 on base chain. Right. Structurally, the token contract itself, based on its address, seems okay. The tokenomics are fairly standard, 1 billion total supply, split 25% team, 25% investors, about 24% for ecosystem rewards, 10% for liquidity. Pretty typical distribution. Now, security-wise, a bit of a yellow flag. No major independent third-party audit from a big-name firm was found. That's usually recommended for launches this size. However, an AI audit did check some boxes like mintable OO, meaning they can't just make more tokens, and freezable OO, meaning they can't block individual holders.
But that AI audit did find a centralization risk, didn't it? Where was that?
Yes, it flagged medium centralization risk detected in token distribution. And this is key. We need to separate the contract's design from its operational use. The official team vesting the 36-month lockup that was coded in, visible, looked secure. That was the promise. But the banana gun moves, those were done using team-controlled wallets operating outside that visible vesting schedule. So the centralization risk wasn't a bug in the token code itself, but is who controlled these other wallets and what they could do without oversight. The team could move huge sums without the market knowing why or where the money was going.
Okay, so verdict. The smart contract seems basically sound. The failure wasn't technical, it was operational. Human error, communication error. Which brings us back to who's responsible for that 61-63% price crash?
It has to fall primarily on the team. It wasn't a tech failure, it was a management failure. They didn't disclose the banana gun beforehand, they operated opaquely, they created this huge information gap, hurting retail investors, and then they handled the fallout poorly. Even if their intention was good, they held critical market info that others didn't, which is fundamentally unfair in a supposedly trustless system.
But we should acknowledge the mitigating factors, right? The theoretical long-term commitment from the vesting, the potential anti-bot motive. Does that soften the blow at all?
It maybe explains why they did it, but it absolutely doesn't excuse how they did it. In DeFi, especially with a new launch, you need radical transparency. They should have documented the mechanism, maybe had an independent party manage it, communicated proactively. The bottom line is that drop from 72 cents to 28 cents happened because trust collapsed due to their actions, not because the underlying platform suddenly broke.
So how's the community reacting now? Are they buying the explanation? Are they sticking together?
No, not at all. The community is completely fractured. You can see basically 4 camps. First, you've got the really disillusioned holders people who bought near the top and feel burned, angry, demanding answers or even compensation. Second, you have the skeptics. These are often more experienced crypto folks who just aren't buying the banana gun story because there's no proof, no verification. The lack of transparency makes the explanation ring hollow to them. Then you've got the people looking ahead. Right. Third group, the price bottom hunters. They see the crash, look at the underlying tech, the CLOB, the volume, the buyback plan, and think, okay, the crisis is priced in. This might be a bargain now at $0.28. They're betting on the fundamentals. And finally, there's a group just waiting, cautiously awaiting clarity. They want to see if the team actually delivers on promises of better governance, real transparency moving forward. The project's future really depends on which of these groups wins out.
Okay, let's wrap this up. Limitless Labs presents this really complex picture. You've got a team with serious credentials, a founder with VC backing, and a huge vision. The technology itself seems strong. $400 million in volume proves that. Plus, the CLU, the revenue buyback, they had good community buzz going in.
The whole thing almost got derailed by a massive failure in launch execution and transparency. That operational secrecy around the banana gun, even if the intent wasn't malicious, it caused panic, tanked the price by over 60%, and just shattered trust. It's a hard lesson. In DeFi, trust is everything, and operational transparency has to be absolute and proactive. That 61% drop wasn't about the tech failing. It was about trust failing.
Which leaves them in a tough spot. They have the roadmap, they have the tech that could potentially recover, but the big question is whether that long-term team commitment can overcome the credibility they lost so quickly. They're going to be under intense scrutiny now.
And that really leads us to the final provocative question for you, the listener, to chew on. Look at the information asymmetry revealed here. Teams always know more than retail investors during these complex launches. Can any project like this truly succeed without total, audited, upfront transparency about every single operational mechanism, no matter how well-intentioned? Limitless signal commitment, but their operational risk management failed spectacularly. What's the real price of losing credibility in an environment that's supposed to be trustless?